Advanced Financial Accounting. In this presentation, we're going to talk about a consolidation for a non-wholly owned subsidiary. So in other words, we have a parent-subsidiary relationship, but the parent doesn't own 100% of the outstanding common stock of the subsidiary, but something other than 100%. In other words, over 51% controlling interest, less than 100%. Get ready to account with Advanced Financial Accounting. Non-controlling interest often will be represented NCI, non-controlling interest. So notice if we have a parent-subsidiary relationship, we're talking about there is some controlling interest. The controlling interest is the interest that's going to be over 51%. However, if we don't have 100% ownership, then we have the amount that's not in control, and that of course is going to be the non-controlling interest. So non-controlling interest, NCI, controlling interest is needed for consolidation. Obviously, if we're going to consolidate this thing, that means typically that the parent has some controlling interest over 51%. A 100% is not needed. So 100% of ownership, in other words, by one parent to the other is not necessary for a consolidation to take place. Control is necessary, which is typically over 51%. Less than 100% ownership will result in a non-controlling shareholder, those other than the parent. So obviously if we have 51%, if we're the parent, we have 51% of the subsidiary voting common stock, we win every vote. Therefore, we would think that we have control as the parent in that case. However, there are still the other whoever, whatever not, that aren't the 51%. You know, they still have stock and they still have claims to the net assets of the organization, even though they don't have a controlling interest and won't win a vote again, if it's something contra to the controlling interest vote. So what do we do about that non-controlling interest? So then we have the non-controlling interest is the claim of the non-controlling shareholders on the net assets and income of the subsidiary. So what does it mean to be a non-controlling interest? Obviously, we're talking about shareholders that, own the company. Now, they don't have a say as much. They can vote. Part of what you can do is vote as the shareholder of the company, but you're not going to override if one individual or one company owns 51%. What you do have, though, is you do, of course, have the claims to the net assets of the organization, meaning assets minus liabilities. You have claim to the net assets of the organization. And you can think of that in terms, of course, if the organization was to go bankrupt or was to liquidate for whatever reason, then if they were to distribute the net assets, liquidate, distribute, then, the claim, the net asset worth of the non-controlling interest would go to the non-controlling interest. So in other words, you can think about it basically, the controlling interest has control over, in essence, the decision-making process because their vote goes. They're the one that has control over kind of where the assets are going to be utilized in order to generate revenue, in essence, at least at that level. But obviously they don't have claim to the net assets because the non-controlling interest still has claim to the net assets. So of their portion. Non-controlling interest is also called minority interest. So if there's a controlling interest, you can recall the other side, the other interest, the other non-51 or over interest portion being the minority interest or the non-controlling interest. Issues with the non-controlling interest, the NCI. So now we have a situation where we're saying, all right, we have a parent-subsidiary relationship. We want to think about consolidating if there's a controlling interest over the 51%, great. But we still have this non-controlling interest. What's going to be the problem? What kind of problems is that going to cause us when we do the consolidation? So the consolidated financial statements will generally be for 100% of each line item. So in other words, if you talk about S and say that company, the subsidiary, and you have a non-controlling interest, say 10%, it's not like you're going to take 10% of each line item. That's one way you might think of it. We're generally going to be consolidating the entire thing together for each line item and then representing the non-controlling interest in one or two accounts on the balance sheet and income statement. So we'll see examples of that, and that'll make more sense as we go through example problems. How to report the non-controlling interest on consolidated financial statements. So if we consolidate this thing together and we have each line item basically at 100%, well, how are we going to account for the fact that the non-controlling interest does have a claim for it in some way? And we're typically going to put one line item in the equity section of the balance sheet and a line item in the income statement representing that non-controlling interest. So if you have that non-controlling interest, then you might think, okay, what are my options to account for that non-controlling interest? So you could have the proportional consideration, and then you can have the full consideration. Now, just so you know, the full consideration is going to be generally accepted accounting principles here. So that's typically what we're going to do. But just realize that if you were just to think through this and say, well, how might I do this? How might I report this? Then these are going to be, the options that would probably come to mind. So percent consolidation, I can either show the line items basically at 100% or less than 100%. So for example, if I had a 90% interest for the controlling interest, 10% for the non-controlling, therefore, then you could say, well, maybe I'll consolidate less than 100% of the subsidiary, 90% of the subsidiary. Or I can have the full consolidation and add them all together and represent the full consolidation. So we're typically going to be doing the full consolidation here because, as we'll see, it'll be in compliance with generally accepted accounting principles so that's the way we will typically go. Reports the non-controlling interest amounts. So either if we just don't report the non-controlling interest, we could say, okay, I'm going to report, say, the non-controlling interest line items, each line item on the balance sheet and income statement at basically 90% rather than 100%, and then I'm just not going to show the non-controlling interest because we're just not going to combine the non-controlling interest into the combined financial statements because we're going to remove that 90%. So we'll just not show it in the consolidated, and they can look then at the subsidiary's financial statements to see that in the full amount. Or you do show it. So in this scenario, we're going to say, okay, we're going to show the full 100% combined together, and then we'll show in one line item on the balance sheet and income statement the amount of the consolidation that's going to be represented, the non-controlling interest in it. This will make more sense when we do an actual problem for it, but this is going to be the line over here, full consolidation, that we'll typically be using. Complies with U.S. generally accepted accounting principles, GAAP. This proportional idea does not. So again, this idea makes sense. You could think about this and say, well, that was obviously considered one way you can make this whole thing work. But the one that's going to be in compliance with generally accepted accounting principles is going to be the item over here. And then complexity, you might say, oh, well, this one over here is probably less difficult than the full consolidation because we're going to have to add those other accounts. But it was chosen, of course, to go with the full consolidation, so that's what we're going to be using. Now, why would generally accepted accounting principles want the full consolidation? Well, if you do the full consolidation, you can kind of think of it as, the parent company has control over the assets and liabilities of the subsidiary, even though they don't have claim to the net assets, really. So most of the people that are looking at the consolidated financial statements have an interest in the parent. So they're concerned about the parent company, and so they want to know, what assets and liabilities the parent has control over, and the performance. If you look at the income statement, how did the parent company do? Because ultimately the buck stops them, right? They have the ultimate say over what's going to happen, at least at the top level. So they want to know what was the performance that was done on the total assets and minus liabilities that you ultimately have control over. So if you have the full consolidation, that will show that. And then if you can also show in just one line item the proportion of the assets and the proportion of the performance, the proportion of the equity, in other words, that represents the net assets that are not going to have claim to by the parent. In other words, if you were to liquidate, that's the portion that would go to the subsidiary. I believe it was thought then that that's going to be a better representation than kind of eliminating the 10% or the non-controlling interest and just not showing that in the consolidated. Because if you did this over here, if you removed the 10%, didn't show that 10% in the consolidation, then you're not really showing 10% that, although the parent doesn't have claim to it, they do have control over it, in essence, on how to use those, because ultimately they have the voting power to do so. So that's, some thoughts in terms of why you're going to basically use this full consolidation over here. Full consolidation required by generally accepted accounting principles, GAAP. 2 new accounts are used in the consolidated statement. So we got the 2 new accounts. There's one is going to be the NCI, non-controlling interest, in other words, in net income of the subsidiary. Acts like an expense in the consolidated income statement, reports income that doesn't belong to us. So in other words, we're going to run the income statement combining income together, meaning parent company, subsidiary company, the full subsidiary, 100%, we're going to put that together. Then at the bottom of the income statement, we're going to say, by the way, here's just one line item, represent the portion of net income. In our case, we're going to say 10% of net income, the non-controlling interest, that doesn't belong to the parent. That's going to be part of equity. That's going to be part of the subsidiary's equity there. So it'll basically act like an expense account in our little worksheet. And then we're going to have a non-controlling interest in net assets of the subsidiary, equity of unrelated owners, net assets on your balance sheet not belonging to us. So in other words, we're going to say, here's the assets, here's the liabilities. So you can see assets minus liabilities. You can see the equity section as a total. That basically says, hey, look, this is what we, the parent company, basically have control over. We can tell the people ultimately what to do with the net assets here. And this income statement is obviously the performance of those net assets that we have control over. And then we're also going to add this account saying, even though we have control over these net assets, we don't have claim to them. In other words, if we were to liquidate, for example, that's the portion in our example, 10%, that would be going to the non-controlling interest. So we're going to be adding these two accounts in the process. Where to put the non-controlling interest net assets? Must report in equity. So we're typically going to be putting that in equity. And prior to that, there was some kind of confusion. Note, this should say note. The old rules may have allowed it to be reported in the mezzanine or in between place between liabilities and equity. So you might see in older financial statements kind of like a limbo space, like a new category in there. But in essence, you're thinking of it as basically a breakout within the equity section. So you got your equity section, and then you've got this non-controlling interest that will be in there as well. Computation and presentation of income to the non-controlling interest. Generally, the computation of the non-controlling interest is a simple proportionate share of the subsidiary's net income calculation. So you might say, well, that sounds all well and good, but how do we actually get that number? That sounds kind of a little bit complex. But it's not that bad usually, because obviously if you take the net income number of the subsidiary and if the parent has 90% controlling interest, then 90% of it would be parent, 10% would be the non-controlling interest. So you would just take the 10%. So usually it's a proportional calculation, not too difficult. Presentation. Term consolidation net income needs to be applied to the income available to all stockholders, and the allocation of that income between the controlling and non-controlling stockholders is included in the consolidated income statement. So what you're going to have then is basically the consolidated income statement. You got revenue minus expenses, then you got your net income there, and then you're going to have another basically line that's going to say, hey, and this is the amount of net income that basically isn't the majority shareholders don't have claim to. In other words, it's the minority portion. Now, I know this whole process may seem a little bit abstract as we go through this now. How do we get it to be less abstract? We'll work problems. So as we go through the practice problems, this whole process will become a lot more concrete.